Hello and welcome to the Yale SOM Exchange webinar, Financial Stability in the COVID Era. Yale SOM Exchange is the Yale School of Management's series of online conversations. This series provides alumni and the entire Yale SOM community with opportunities to keep learning about faculty research, current events, and career strategies. I'm Andrew Metrick, the Janet L. Yellen Professor of Finance and Management and the Director of the Yale Program on Financial Stability at the Yale School of Management. And today I am joined by Alejandro Diaz de Leon, Governor of the Banco de Mexico. Alejandro earned a master's degree in public and private management in 1995 from Yale SOM. That's the most important part of his biography. Also a BA in economics from ITAM in 1993. And he began his career at the Banco de Mexico in 1991, where he held several different positions over the years, including macroeconomic analysis director and economic studies director. In October 2007, he was appointed general director of the National Pension Fund of State Workers, and then appointed the head of the debt management office at Mexico's Ministry of Finance from January 2011 to November 2015, where he was in charge of the government's internal and external financing and the oil hedging strategy. He was later appointed general director of Mexico's Export-Import Bank, and after being nominated by Mexico's president, confirmed by the Senate, in January 1st, 2017, he became part of Banco de Mexico's governing board as deputy governor. He was appointed by Mexico's president to serve as governor on December 1st, 2017, with a term that runs through the end of December 2021. Governor Diaz de Leon, welcome and thank you for joining me this morning.
Thank you, Professor Metrick. Andrew, I really enjoyed your invitation to this Yale SOM webinar. It's an honor for me. As you can tell, SOM is very close to my heart. And just looking at the logo of the school and so on, and also thinking about how important it is to look through each other's arguments and issues around the table, especially in a world that has been getting more polarized everywhere. I think it is very important, and the message coming from the logo and from SOM school resounds more than ever. So thank you for the invitation.
Thank you. All right, so the plan here is that I've got a few questions for the governor, and I'm going to ask, we'll do my version of the Q&A for about the first half of this webinar. And then with about 25 minutes remaining, we're going to turn to questions from any of our participants who are on the line. You should feel free, while I'm asking the questions in the first half an hour or so, to post your questions in the Q&A. So there should be a Q&A button that you see on the webinar. Please post your questions on that, and I'll be watching those questions. And then about halfway through, I'll start asking your questions of the governor. Okay, then, without further ado, let's get started. It's been over 20 years since Mexico faced its own financial crisis. While the Mexican economy was also hit by the global financial crisis, and it's been affected by the current one, these episodes differ from the so-called tequila crisis in that the Mexican financial system was not at the core of it. In this regard, what would you say is different for both the Mexican economy and the financial system between the tequila crisis and the current one?
Yes, Andrew. Let me start saying that probably the most significant inflection point in terms of the Mexican financial system took place in '82. In '82, the banking sector was nationalized. As you can imagine, that had a huge toll on the system. The system was privatized in early '90s. And by '92, virtually all of the commercial banks were privatized again. And you can remember '92 and '93, NAFTA was approved. So there was a lot of momentum of pro-market openness type of elements around the Mexican economy. And actually, those were the years that I arrived at SOM. I arrived in '93, and I graduated in '95. So I arrived at SOM when Mexico was opening to the external sector, both in terms of trade and financial flows. But I returned to a very different Mexico in '95 because the tequila crisis has already hit. And it was a very severe crisis. And one of the lessons is there are no shortcuts to doing the job that requires to be done in terms of the financial resilience. So it was expected that after the privatization, things could be okay just around the corner. And I think what it was very clear but that was not the case. We had rapid growth in terms of credit. The financial size of the banking system as a share of GDP was 44% of GDP. We had a very costly banking crisis, above 20 percentage points of GDP. That means almost 50 cents out of every peso that was as a deposit had to be backed by the fiscal accounts, which is enormous. And not only that, that's the direct cost, but the indirect cost was in disintermediation. We had a very painful and long disintermediation process. And actually, the share of the balance sheet of the commercial banks shrank dramatically from the 44% of GDP to around 15% percentage points of GDP. So that was a very high toll on the financial system. One of the ways to get out of this was to open to external and foreign banks to all own the largest Mexican banks. And we thought we were going to get away with recurrent financial crisis as the global banks had a major stronghold on the domestic financial system. And little did we know that in 2008 and 9, we were going to have the reverse. Actually, the crisis coming from abroad, not homegrown, and that the large financial bank and the financial system and the large banks were going to experience trouble in their home offices rather than in Mexico. So that crisis took Mexico in a different type of frequency. We didn't share the asset-backed securities challenges, problems, and so on. So for Mexico, the 2008 and 9 crisis was basically side effects of the epicenter of the crisis in the US and Europe and elsewhere. And it was part of the rebuilding of the capital base and a more, I would say, state-of-the-art type of banking and financial system. And obviously, it was a hard toll on 2008 and 9, but it had been gradually building strong capital buffers, strong liquidity, and gradually financial deepening has been increasing. This time around with the COVID, this shock has taken, I would say, the banking system and the financial system in general in a relative strong position in terms of capital base, in terms of liquidity, and in terms of management and corporate governance and so on. This has been, I would say, as a result of, as I said, over 2 decades of dealing with a very painful and costly banking crisis. And but nonetheless, there are significant challenges ahead.
Thank you. That's an excellent introduction. So now we're going to move to those challenges, and specifically the way that those challenges might be different in emerging markets and advanced economies. A question we get a lot from our students here at Yale SOM. So the current shock, which is of course common around the world, is likely to have different impact on advanced economies and emerging markets. The fundamentals, monetary and fiscal room for maneuvering, depth and features of the financial systems differ, obviously, across those two types of countries. What would you say are the main differences between advanced economies and emerging markets which have driven the policy responses so far? And how do you think this will affect the way each of these two groups of economies will emerge from the crisis?
Yes. Well, let me start with some of the common shocks that we are all facing and how it manifests with different challenges in emerging markets vis-a-vis advanced economies. Clearly, we have all been facing what we can say a shock with 3 phases on the economic dimension. Obviously, on the human side, it is a tragedy on every dimension. But let me focus on the economic dimension. We have faced a shock with 3 phases. One is a supply shock, a demand shock, and a financial shock. A supply shock because of the shutdown and the social distancing. Clearly, the production of a wide array of goods and services has been hampered, and a lot of that production has been significantly affected. On the demand side, because clearly income to households and to companies has been significantly affected, and that has obviously changed expenditure patterns in a significant way. And on the financial side, and probably this is one of the first layers of contrast, what we saw was a very sharp risk aversion dynamics. a dash for cash everywhere, in advanced and in emerging. And I think this is where some of the common features can be highlighted. Central banks in different places put different measures in trying to foster liquidity and try to avoid bottlenecks in the financial credit channel. And central banks we have had for a very long time as part of our, let's say, concept and mandate to basically to avoid or avert these panic dynamics, these bad equilibriums, and we need to step in and try to see how we can foster more orderly conditions. But I would say that in the case of advanced economies, and this has to do also with the fiscal position, the fact that advanced economies tend to be, let's say, capital exporters. They have sufficient financial domestic savings, and they have a surplus that they literally invest abroad, in contrast to emerging markets that were capital import economies. So we're more, we rely more, and especially at the margin, from financing from abroad. So that means that capital outflows and capital flows, cross-border capital flows, play a key and relevant element. And that means that we need to, of course, different emerging markets have different degree of openness. In the case of Mexico, we are the second most liquid emerging market currency in the world, just behind the renminbi. We are one of the very few currencies that has full convertibility. You can trade the peso 24/7. It is very low cost to have a long or short position on the peso. So given those conditions, that implies that we need to remain an attractive place for investment on a permanent basis. So that means that you need to be extra prudent on a strong macro stance and using the policy space available judiciously and not carelessly. Now let me go into the policy space. Clearly, advanced economies, for the reasons that I mentioned in terms of surplus and very strong institutions, they have more room to maneuver in terms of public sector debt. For emerging markets, it is more relevant. We can even talk about the IMF's 3 layers of public debt to GDP ratios level, which is below 50%, the no worry zone, the 70 to 50%, the highly monitoring zone, and the 70 and above debt to GDP levels, which is the worry zone. And I think that highlights that different emerging markets have different policy space. And you could look at examples of countries with very low debt to GDP levels that they have been able to spend in an aggressive way to try to foster and to support aggregate demand. And you will see other countries that don't enjoy that space, that have been using obviously less space, and others that have been doing, you can say, all in, and they have been even, they don't have that much space. Nonetheless, they have been spending a significant amount trying to bet on a speedy recovery. And of course, that entails also a different risk trade-off on how much you want to put at risk the macro mix and the macro balance. So in the case of Mexico, we have tried, because of this openness, special openness that we have and so on, we have tried to be especially careful with not putting at risk the macro mix. And I think this, at the end of the day, you can never be too certain that things won't have additional shocks around the corner. And I would say this in general basically describes how in emerging markets we have additional challenges. In terms of monetary policy, what this has entailed is for us to be more gradual and how we move interest rates in a downward path. We know that at times of acute crisis, probably the global risk aversion factors tend to dominate in the outflows. But nonetheless, after that is settled down, and clearly the decisions and the support package in advanced economies played a key role to reduce risk aversion globally, and clearly emerging markets benefit from that. Nonetheless, I think that you need to be mindful that your own idiosyncratic elements and variables also play a key role as an attractive and a differentiation device vis-a-vis other emerging markets. And I think what we have to do is to have our domestic financial markets absorb the shock in the most orderly way possible.
Thank you. All right. Well, we're now gonna to ask some pretty specific questions then about Mexico and how you're dealing with that, which is early on in April, the Mexican financial authorities issued temporary flexibilities on liquidity requirements, so allowing banks to report an LCR below the minimum regulatory level, as well as the use of capital buffers so that banks could use the capital conservation buffer without deteriorating their minimum solvency. Furthermore, also in April, the bank unveiled a series of liquidity measures totaling 3.3% of GDP, or $30 billion in our language over here, which was prolonged until February 2021. So first, how do you think these measures, how well have they done at supporting the banking system so far? Do you expect to expand the effective period of these measures? And what would you say have been the main implementation challenges, in particular with respect low level of usage of some of these programs directed at the small and medium enterprises and individuals?
Mhm. Very good, Andrew. Let me start with the first part of the measures that they talk about, which was basically the key objective was to avoid procyclicality coming from financial regulation. And basically, we were trying to avoid that the regulation could amplify these risk aversion, these dash for cash, and these problems around liquidity. And these may come from different sources. One of them is as you get a lot of liquidity and volatility, and you get, for example, in the liquidity coefficients, you may get assets that look less liquid than they are before the shock, and you may ask for additional buffers or for a change into more hyper liquid or ultra liquid assets. So these may just exacerbate these in a procyclical manner. So the first action was to avoid that procyclicality, to look into the window of instruments before the shock, not in the midst of the shock, and to take that into consideration, so to avoid these amplification effect. In terms of the capital buffers, it was to provide, to give assurance to banks that they could use that space, and they had that backstop that they could use. And I think that is important because one of the key issues that we wanted to convey was this time around, in sharp contrast with 94 and 95 that we talked about the tequila crisis, this time around, the financial sector and the banking sector is part of the solution, not part of the problem. And we don't want them going into the other direction. And we know that they need to finance in order for households and companies to smooth out the shock and the reduction of their revenues or income because of the pandemic and the shock that we are all facing. So we wanted to have them in a position where they were willing to lend and avoid these bottlenecks in the credit channel. And now let me go into the different measures that we put in place. We basically looked to the whole spectrum of the credit channel, from the wholesale market, the interbank market, the federal government securities debt market, corporate debt market, all the way up to the small and medium enterprises and households. And what we wanted to do is to have different measures that could provide support and liquidity throughout the whole spectrum. So a lot of our measures have been dealing with the wholesale interbank funding market, the government debt market, corporate debt market, and in those segments, our facilities have been broadly used, I would say very useful, and they have allowed to change these dash for cash dynamics that prevailed in April and May, and allow financial intermediaries to basically do their ongoing business. Now, there is a challenge, and you highlighted in the last part of the question, regarding the financing for small and medium enterprises and for households. And this is a key element where it is important to distinguish what can the central bank do and what needs to be done by the Treasury. And I think in the case of the US, the example is very clear. The Fed has said in numerous occasions that they are a liquidity facility, not a spending facility, and that the spending gets done by the Treasury. In this type of financing, I think it is very clear. We can provide liquidity and we can provide financing. but we cannot provide a loss absorbing capacity. And that comes from the treasury instruments, in particular, these guarantee programs. And throughout the world, these debt guarantee schemes have been quite used in this pandemic, basically to provide support to reduce the credit risk and the overall risk that banks are facing with new loans and new lending, and basically not to have a sudden stop on the financing. Clearly, this takes us back into the how much you use the fiscal balance sheet to provide some of these support programs. And this is always a tough decision. And this is a decision that it is not in our hands. This is on the Minister of Finance hands and on the executive. Our only recommendation about this is that fiscal accounts need to be sustainable. That there are several ways to achieve sustainability. If you want to spend more, you need more revenues. If you don't want to collect more taxes, then you have to spend less. At the end of the day, you need to have this coincidence between how much you want to spend and how much are your permanent sources of revenue. And you may increase your permanent sources of revenue, not necessarily increasing tax tomorrow, but 2 years ahead. But intertemporally, you align and make sustainable the fiscal position. That is always a tough decision, that it is not in our hands. And so far, we have seen relatively few programs in the credit guarantee scheme dimension. So the financing is there. The total loss absorbing capacity is not that large. So that's why some of these facilities have not been used. And also, I would have to say that some of the largest banks even have a cost of funds through the checking accounts and so on, lower than even our policy rate. So even at the margin, if they would be financing those sectors, probably they will not be using our money. They will be using their deposits.
Got it. So that was a very domestic question that I just asked you. So now I'm going to move to a more international one, which is that also early on in the COVID-19 crisis, Mexico experienced significant capital outflows. And credit ratings for Mexico and for Pemex, the national oil company, were downgraded in April and again in June. Recently, sovereign risk has slightly improved. How did the Bank of Mexico cope with this sudden stop, and what conditions could attract the capital inflows back to Mexico?
Yes, let me start putting some numbers in this. We faced a very significant capital outflow in March and April, around 14 billion US dollars of capital outflow. This is obviously Mexico has been integrating more our domestic financial markets globally, and non-residents share of Mexican domestic government bonds is relatively large. It went all the way up to 30%. In some specific bonds, the fixed income bonds, it was almost 50%. So it's a significant share. It's a large share. So clearly, one of the challenges that we have to face is how can we have an adequate adjustment in markets in a very acute and significant shock as the ones we faced in March. And here there are a lot of questions. What is the role for FX policy? Should we intervene or not? Should we use international reserves to smooth this out or not? What we have seen, and I mentioned before that we have a very deep and liquid FX market. And it is the second most liquid in the emerging market space. What that enables is for some of these shocks to be absorbed in a more or less, of course, with price swings, but those shocks are at the end of the day being absorbed. So the FX depreciation in the midst of the shock in March was almost 30%. The depreciation today is less than 7%. So allowing for those large price swings, I think it also allows for some of the self-correcting properties of markets to play along. I think it is if you stand to enlarge the exit door, you may not necessarily be doing the most constructive thing for the market as a whole and for the incentives for non-domestic residents. So at the end of the day, having stronger liquid and more deep markets have helped in a significant way. And nonetheless, this is clearly a challenge. And we see also, even in the IMF, for example, this integrated framework that calls for, let's say, a more eclectic and heterogeneous type of responses when facing some of these shocks, and that even have these now benignly called capital flow management measures and so on. I think you have to be very judicious about that, because I think markets don't like surprises. Markets like predictability, that you stick to the game plan, and they don't like pulling genies out of the bottle when the going gets rough. So I think in Mexico in the last more than 2 decades has been quite disciplined in trying to be predictable, even in the midst of a very acute and pronounced shock.
Great, thank you. Now I'm going to move on to the question that I'm sure you get everywhere you go. You probably can't even go out to the store to buy some groceries without somebody asking you about interest rates. So this year rates have been cut from 7.25% to 4.25% as of September. And your inflation target is 3% and expressed with narrow room to maneuver further. Before the last cut, inflation had risen from 3.6 to 4.1. Now above target. So what is driving the monetary policy decisions now? And then, of course, the question that you can answer only as much as you want to. What's the expectation for the next year?
Yes, clearly we have faced among these challenges, all of these shocks from COVID, from the capital outflows, from the FX depreciation, and so on, also have an incidence or translate also into inflation. And those have common traits in different countries, but with different degrees. What we have seen from COVID is that it has increased the prices of food or foodstuff, and it had decreased the prices of services. And in the case of emerging markets with FX depreciation, there are some tradable goods that have had some pressures because of the movement on the exchange rate. Overall, in the case of Mexico, and this is kind of peculiar, because when you look at inflation throughout the world, you would see that not only all of the advanced, but a very large number of emerging countries have inflation below their targets and even getting further down. So negative inflation gap, and in some cases, an increasing negative inflation gap. In the case of Mexico, the inflation is above our target, and it has been increasing in the last 4 months. So one of the key challenges, I will just give 2 brief examples of why this is happening. In terms of foodstuff and food prices in Mexico, and you can see Mexico as, let's say, a marginal supplier of foodstuff to the US market. So the volatility in the US market in terms of food prices amplifies that shock in Mexico. So when there is a bad crop of tomatoes in the US, our exports to the US increase immensely. And that puts pressures on domestic prices. So being the marginal supplier in a very large market introduces additional volatility into some of these prices in Mexico. So first, the first item is larger swings in prices. And the other dimension is we have larger weights in our CPI on foodstuff and lower in services. And this is not only when compared to advanced economies, even when compared to emerging markets in let's say, in Latin America, we have, for a very peculiar reason, there was a very strong recommendation to have the CPI representative, not only at the urban level, but also at the rural, so that we had a national, well-done CPI. In some other emerging markets, they have their indices only at the urban level. And you can guess that the effect of food prices and services is more acute in the urban areas rather than in the rural areas. So having that larger weight of foodstuff that comes from including the rural areas, and that lower weight of some services by including the rural areas, it also works as an amplifier of the particular shocks that we are facing due to COVID. So this explains why the dynamics of inflation has been different. Now, we understand that some of these transitory supply shocks have had a larger effect in Mexico than elsewhere. But at the end of the day, given the significant shock and negative output gap that we are facing, we still have aggregate demand pressures going south on prices. And that will dominate a little bit further around the block. So it is only a transitory shock that we have been juggling with in the most recent months, but we expect that the 12 to 24 month ahead inflation will be around our 3% target. And in terms of monetary policy decisions, what we said in our most recent decision last week, it was basically that given the level of inflation and given that we have already cut 400 basis points from August last year, we were going to make a pause so we could confirm this downward path and that we expect on inflation, both core and overall CPI. And if it basically to allow in a more, let's say, crude way to say that we're going to get the optionality from wait and see if the scenario that we expect actually materialize or not.
Got it. Okay, so actually we are ready to move on to take some questions from our participants. So we do have a few that are already posted in the Q&A. I encourage people to continue to post questions. The first one that I'm going to ask you is a direct follow-up to what you just answered. As what must happen to you all the time when if you're giving your press conferences and talking about cutting rates, is you give a very careful answer explaining what you're doing, and then somebody basically asks you almost exactly the same question to try to trick you into giving a slightly different answer with a little more information. So I'm going to do that too. From our anonymous attendee, we have a question that the bank signaled that it could resume. You're on pause now, but you could resume cutting rates in the near future under certain conditions. All right, what are those conditions, Governor? So what are you looking for before you would decide to end the pause and start cutting rates again?
Well, what we alluded in our communique, and as you know, I'm familiar with these hide and seek type of dynamics.
I'm sure you are.
But I would say the following: we've been facing a very complex and a very volatile environment. In the case of Mexico, for at least the last 4 years, and in the case of the world, very clearly this year. And there is always a trade-off. How much guidance should we give, and how much nuance and data dependency should we highlight? And in the case of Mexico, and I think in the case of emerging markets, and this goes directly into one of the differences, when you are an advanced economy, a very large advanced economy like the US or the Eurozone or so on, you find that guidance allows you to double down on your policy mix and allows you to be more forceful on the type of messages that you want to convey. But you're putting at risk also some of the credibility if you need to backtrack. But in the case of those economies, it is very low, that has a very low probability. In emerging markets, the fact that we may face additional shocks, additional sources of uncertainty, additional inflationary pressures coming from different sources that you could have not anticipated, that increases the trade-off between guidance or nuance. So what we try to be very clear is our reaction function. Our reaction function, not a prescription or a trend for interest rates. And our reaction function is basically around our inflation forecast. And what we say is basically we provide a 8-quarter ahead forecast of inflation. And if we get some, let's say, additional pressures on inflation that pushes us to revise upwards that path, that forecast, well, that reduces the room to maneuver of the central bank. If we get on the reverse, if we get shocks that put less pressure on prices, not only on current or the most recent data numbers, obviously that goes into it, but it's not only that. Obviously, it's the whole range of factors that go into the forecast. And as we get less pressure and we get a revision of our forecast downwards, well, that is allowing us or giving us more room to maneuver. So at the end of the day, what would our next actions be, and what are the drivers? At the end is all of the variables that go into our inflation forecast mix that will convey how challenging or more challenge or easier to get to our target.
Got it. Thank you. Let's stay on this topic of inflation and how you think about it, since I'm sure you don't get to talk and think enough about inflation every single day. You must dream about it. But I have a question here, and this is something that I did not know, so I'm curious to actually get some expert opinion. This is a question from Adrian Garcia. And what is your view that inflation pressures in Mexico are caused by the fact that there are sectors with few players who have quasi-monopoly pricing power? So is that something that enters into the thinking?
There is always a lot of, I would say, deep thought about the causes of inflation. And you can argue that, and you can also say that emerging markets, one of our serious source of concern is that we may have not necessarily full competitive markets in every single relevant market. And we may get, in some cases, some type of market power or dominance. So this is always an ongoing concern. Now, the key question is, does that affect the price level or inflation? I think most will agree that that may affect the price level and not necessarily inflation. Because if you argue that less competitive markets may affect inflation dynamics, that may say that at the margin, that let's say dominant market share is changing through time, or is allowing to move or to increase, let's say, dynamically. So probably it is a little bit of both. I think overall, you can say that lack of adequate competition will have an effect on the price level. And that is the less controversial item around that. Now, is it completely neutral on inflation dynamics? Not necessarily. And I can put an example. There is a lot of debate in Mexico, for example, when some commodity prices go up, people here, price setters are very quick to increase prices. And when they go down, they are less eager to reduce those prices, in particular in LP gas, liquid petroleum gas, or natural gas, and so on. So it may have some dynamics around it, but by and large, you could argue that lack of adequate competition will have an effect on the price level, not necessarily on inflation. But nonetheless, it is obviously an item that, as a central bank, we have always been concerned of, and we have tried to work with the National Competition Commission in trying to address some of these challenges.
Thank you. I'm going to move on a little bit from inflation, but I'm going to come back to it at the end. I figure it seems only fair to let you not talk about inflation for a few minutes in every day. So I'll ask you some different questions. Here's a question from Tito Vidauri, and he asks, how fintech players can help in increasing financial inclusion in Mexico and to increase competition in the system? And how is the Banco de Mexico helping to support this process?
Yes, actually, Tito's question, and hi, Tito, I think it reflects the fact that in the case of Mexico, and I mentioned the nationalization of commercial banks and then the privatization, and in those two waves, there was concentration. So the number of banks that were nationalized was quite large. When they were nationalized, some consolidation took place. When they were privatized, also some consolidation took place. And then when literally foreign banks acquire some domestic banks, further consolidation took place. So we have probably a quite concentrated banking system. And we have always tried to see how we can get more competition into the system. One of these dimensions has been the non-bank financial sector. And the non-bank financial sector, it is really a complicated dimension. Probably, I would say that in the late 90s, early 2000s, too much expectations and hope were around that sector that could really circumvent or fast track and grow rapidly and substitute some of the role of the banking sector. That not necessarily took off. I do hope that the new fintech dimension can add to an additional layer of competition. I think that we are at the central bank, we are quite eager to try to see how this fintech can really translate into into better services at lower costs to a larger part of the population. And clearly, I think the advantage of not having the traditional large fixed costs around the banking system, uh, it is very helpful to have more nimble and agile institutions. We are right now in that process. We have a fintech law. We have been revising a lot of new business models and cases that have been put into the hands of the authorities. This is shared by the National Banking and Securities Commission and ourselves. This is a process. We try to foster that as much as possible. We have even ourselves developed we have an RTGS payment system that works 24/7, and we are literally providing the last mile with QR codes and basically allowing for this infrastructure to try to help both dimensions: financial inclusion, better prices, better services, and a wiser use of technology.
Great, thank you. So now, next question comes from Oscar Lacayo, and he asks, are there any measures that other countries have implemented that Mexico hasn't to soften economic shocks due to COVID? And would these measures also work in Mexico?
Well, this has basically two dimensions. Let's say on the fiscal side, I think I already talked about the fiscal space and the trade-offs on the fiscal side, and it's really not on our hands. Let me go into the monetary. Into the monetary, there has been some debate about the unconventional monetary policies. And these unconventional monetary policies, the question is, can emerging markets do or should be doing unconventional monetary policies? And here, I would like to convey the following message. I think unconventional monetary policies are not something that it is for every country and in any circumstance. It is not an over-the-counter medicine. I think it requires a prescription. It depends on the fiscal space. Why depends on the fiscal space? Basically, unconventional monetary policy is buying the long end of the yield curve to basically compress not only short-term interest rates, but also long-term interest rates to maximize the stimulus on aggregate demand. But guess who? Who gets to issue the long-term instruments? Well, the federal government. So you're financing the federal government in the long-term end of the yield curve. You're reducing the cost of financing of the federal government. Does that entail challenges and risks? I think the answer is yes. It depends on the level of the debt to GDP levels. It depends on the stable sources of revenue of the government. And one of the things that you need to be mindful is that getting you closer to a potential situation of fiscal dominance or not? Are you becoming the leading financier of the federal government or not? And if you are providing a crutch that may even be permanent, you may be in a worse off position as you move along. So unconventional monetary policies can be done in emerging markets, but not for every country and not in every circumstance. And you should be mindful, I think, about some of these additional effects that it can have with these very complex interaction with the fiscal stance, the fiscal policy. Let's not forget, I think the most important element on how to cope on the monetary side with a crisis, you can only do that if you have credibility. If you don't have credibility, you will add up a financial crisis upon a health crisis and a contraction and a GDP, a financial crisis. You will add up a financial crisis. Central banks can bring rates on the long end, on the short end, and also help bring risk premia, inflationary risk premia lower if they have credibility. If we don't have credibility, then everything goes off the roof and we will go back into a kind of 95 crisis, 80s crisis, which is really the worst of them all. If you have an economic crisis and then you add up a financial crisis, then you're in the worst of all worlds possible. So for us, And actually, if you look at the different yield curves of emerging markets, the yield curve in Mexico, the long end of the yield curve has performed relatively better vis-a-vis other emerging markets, in spite of not doing maybe some of these extra or additional elements. So at the end of the day, bring risk premium down so you can bring these long-term yields down. Advanced economy, their risk premium is already very low. So they are bringing that lower with these purchases. In the case of emerging markets, I would say that the thing that it is of first order of importance is bring risk premium down and not be such concerned or worried about buying the securities on your balance sheet.
Got it. Thank you. The next question comes from Ayapa Nair. Ayapan is a master's student in the Systemic Risk program at the Master of Management Studies in Systemic Risk program at Yale. So I'm sure his question is going to be fantastic. Okay. And Ayapan asked, the role and responsibilities of central banks are getting broader and expectations from the public are ever greater. There's a growing gap between what central banks are expected to deliver and what they can actually deliver. Issues such as income inequality and the climate crisis are cases in point. How should central bankers grapple with the paradox of these issues?
Well, I think that as central banks have been playing a larger role, and in some cases a very leading role in facing some of these challenges coming from this crisis, you may get the temptation that it's like a miracle cure. Just go to like miracle medicine. If something is not working, well, ask the central bank to fix it. Let's not forget what central banks do is we issue fiduciary money. We issue paper money, and we determine the terms and conditions of that fiduciary money, which at the end of the day, it's interest rates or the quantity of money. And there's so much you can do with that that cannot necessarily change the more structural, deep-rooted production factors in terms of labor, capital, technology. There are challenges that other policies need to address. And I would even say that we need to be mindful that as much as we use, let's say, these reduction of interest rates and so on, we're also introducing a very challenging dimension, which is we're changing relative prices also of financial assets, of real assets, and so on. And that may have distributional effects and challenges. And so it is not without trade-offs that central banks can step in and avoid, let's say, bad equilibrium, and that can avoid having the worst outcome materializing. But it is not free of cost. It is not painless. And at the end of the day, other policies should also get into the mix. What it is really worrisome, it is that we're getting into a world that for different reasons has gotten to be quite polarized. And I think the polarization of narratives, it's not really helpful. I think, of course, a lot of elements are at play and behind this. We can say that globalization and integration with that technological change, the 2008 and 9 crisis, and now COVID is increasing this tension and this polarization. So this creates agreement in the political realm harder to get. So it's harder to get agreement on the right mix of policies. And given that the central bank is outside of that dynamic, probably is easier for some decisions to basically be adopted and be put in place. I think that as I highlighted and with the logo of SOM in front of me, I think today more than ever, it is very important to try to see the problems with the eye of the others of the other guys in the other side of the table, and try to find the intersection points. I think the intersection points are larger than what we think they are, but we just need to look harder.
Thank you. We have several questions that are kind of following up on the fintech question, sometimes with some more precision. And of course, one hot topic these days is CBDCs. So question from Adam Keeney is, what's your view on the role of central bank digital currencies, CBDCs, and the potential risks to the stability of the Mexican financial system from, in this case, third-party stable coins? So you can think things like Bitcoin or Facebook's Libra, etc. So what's your thinking around that?
Well, I would say that CBDCs are now probably one of the most, I would say, more interesting and highly discussed items among central banks. I think that for a very long time, this topic was probably pushed away. And I think with, not really with Bitcoin, but really with the Libra project, I think that really introduced other trade-offs and put more pressure on moving forward on this topic. And here, I think we should not forget what we're really aiming at. And we're aiming at the, the best social outcome nationally and globally, or are we aiming at just circumvent the current status quo and the central bank, let's say, elements, mandate, and realm, or what are we really trying to achieve with this? Because some of these, let's say, Bitcoin and this dynamic has been literally to circumvent the status quo and to circumvent the current, let's say, monetary regime. Is that really in the best interest of society? I don't think so. I think in the best interest of society is to have a new equilibrium where you can have digital payments done in a very agile way, not only domestically but cross-border. And actually, I am co-chair with the head of the CPMI, John Conliffe, of a cross-border group study at the FSB, precisely to identify we need to improve this. How can we do that? And the CBDC dimension is one of the 19 elements that we are focusing on and trying to improve, because we understand that we need to improve the ecosystem. I do believe that the issue is not really the currency, but the network. We need to have a better network that interconnects whatever we want to do, change from one currency to the other, and so on, not necessarily create a new currency with different features, with different elements. And I do believe that if we have our society's best interest as our goal, and try to see if we can fine-tune the current architecture, we can get into different ways on how to move precisely in that direction without putting at risk a lot of other elements that would not necessarily translate into to a better place for society as a whole.
Thank you. Thank you. So our next question is from Andrea Zuniga, and she asks, do you think the banking sector in Mexico had adequate levels of liquidity and capital to cope with the pandemic? And to what extent do you think that had some impact on continued lending?
I would say that this crisis took the banking system in a relative position of strength in terms of high levels of capital and ample liquidity. But I would not minimize the challenge that we're facing. Obviously, the challenge has been quite severe, more specific and more acute in some sectors and in some segments of the population. So obviously, non-performing loans, it is an ongoing concern and a source of uncertainty. But I think that, again, the banking system is facing this significant challenge from a position of strength. I do hope that all of the elements that have been put at play will allow for these challenges to be adequately met. And in terms of financing, this is always a very tough dynamics, because when you're facing such a severe shock, that increases uncertainty about the repayment capacity for a large number of debtors and for a large number of households and companies, then obviously projects and households are riskier. And if they are riskier, there is obviously a tough trader to identify who are the sound debtors that will remain sound after this is over and who will not. And that always creates a complex dynamics where some segments of the credit portfolio suffer most. For example, in terms of housing, mortgages have been basically growing quite rapidly because there is, in some segments, the need, given that I'm going to spend almost all of the day of every week and of every month in my house, I want a bigger space. So for some that can allow and can do that, they have been trying to improve their housing. But in other segments, it has been a sharp contraction in terms of financing. So, and also given that we have, I would say, a low level of these debt guarantee programs going on in the system, that obviously creates this trade-off. And what we have been seeing in the most recent banking numbers is that credit to the economy has been going down. And I think this is also a trend that it is quite likely to be shared also in other countries too.
Great. So I'm going to ask you just one more question, because we're almost out of time, and there's many good questions that we have received that I'm not getting to, including a large number of questions that are trying to get you to say what Mexican fiscal policy should be and what the political situation in Mexico and the United States. And because we want you to come back and talk to us again, I'm not going to ask you any of those questions. Instead, what I will ask is from another one of our students, this time our expert students in the area, Ivan Garcia Lara. Regarding the inflation risks that Mexico is currently facing, how do the capital outflows impact the prices of goods, since the pass-through seems to be low in the last years before COVID-19 hit?
Well, clearly, when you have such a negative output gap as the one we're getting today, you may get some of these pass-through effects to be weaker than in a regular business cycle. So we can expect to have lower FX depreciation from prices from FX to prices, but nonetheless, that is something that it is also in a mix with other shocks. We're facing the shocks on foodstuff that we talked about. We're facing other elements that are affecting the CPI, the overall CPI. For example, in energy. In energy, we had a very sharp contraction in April, and now as prices started to recover, we're getting a little bit more pressure coming out of energy prices at the margin, even though we're still below the levels prior to the COVID. So there are a lot of moving and several factors going on in this dynamic. So we do expect that some of these shocks that have been affecting the inflation will revert. We hope that takes place sooner rather than later. We hope that those inflation numbers will get closer to our target sooner. And I would say that the following: given that we have a large negative output gap, it is reasonable to expect for that to, at the end of the day, dominate the pricing and prices, the pricing dynamic in general. And especially if we see some of these supply shocks basically averting. And some of them, we have already seen that they have been, let's say, putting less pressure at the margin. Obviously, a lot of hinges on the uncertainty as we go forward in terms of contagion, in terms of vaccine. We start to see a light at the end of the tunnel, but we are still uncertain how many miles we get to ride before we see the full light.
Thank you. So we're just about out of time, but I'd like to give you an opportunity, give the governor an opportunity if you have any closing remarks that you'd like to make, anything that we should have asked you but didn't ask you. Now's the time to answer it.
Well, let me just mention a few probably medium or long-term issues regarding the Mexican economy. I think we're getting into a world that seems to be less globalized and more regional. I think some of the forces that drove globalization, which were low costs, are probably going to be less dominant. One of the factors that I think will dominate as we move forward is trust. And I think in that regard, for geographical reasons, but Mexico is the only emerging market in North America. I do believe that North America has a very, very significant opportunities of development and growth going forward. I think in terms of energy, in terms of technology, the blend of human capital and so on, I think North America is destined to be a very highly competitive region throughout the world. I think we have upgraded and revised NAFTA with now the USMCA, TEMEC, or CUSMA. Now we have three names for the same thing. But nonetheless, I think we have a state-of-the-art treaty, mindful of intellectual property rights, mindful of different labor issues and considerations that are relevant. And I think that is a huge opportunity. So I understand that, and Yale and SOM has always been very strong on globalization, integration, and there are a lot of intersection areas. And I think in North America we can see to each other and have a lot of shared values, shared approaches, and I think that could be significant opportunities for the country as we go forward.
Thank you very much, Governor. And thank you to all of our participants for joining this Yale SOM Exchange webinar. Please keep an eye out for future webinars hosted by the school and visit alumni.som.yale.edu to see upcoming events. Have a great day.
Thank you, Andrew. Thank you for the opportunity. Bye-bye.